Hey guys, I hope you all are doing well. So today we will be looking at a scenario where a fraud occurs in two companies, but in one of the companies the auditor is held liable for the fraud. However, in the other company the auditor goes scot free. You're puzzled, right? I know you're puzzled. Okay, let's decode this with the help of a fictional story and let's prove that this is true. So, without any further ado, let's just jump into the fictional story and see how it works. Yeah, just a moment. Yeah. So let's say there are two entities. Let's say there is an entity A, and there is entity B. Let's say entity A sold goods worth 3 crores to entity B on April 1st. So let's say the fraud arises due to the fact that CFO of entity A is not paid much. So entity A is actually doing well in terms of its operations. Entity A is actually a very big company, but the CFO is not paid much. The CFO is really angry about this. So he wants to pocket a big fat paycheck by doing a fraud on the company. So here is what CFO of company A decides to do. So CFO of company A decides to unite with the CFO of company B, who is his very close friend, and he promises him a cut of the amount which they fraudulently take out of the company. So here's how the fraud scheme is going to be executed by them. So first, so let's go by this in the journal entry flow. So entity A sold goods worth 3 crores to entity B on April 1. So what would be the entry in entity A's books? So entity B account debit to sales, right? So what entry would entity B pass in its books? Purchases account debit to entity A account, right? So let's say the credit period is 30 days. Here's where the twist comes into play. Here's where the story actually starts unfolding. So listen to me really carefully. So here's what the CFO of entity A tells the CFO of entity B. CFO of entity A tells, boss, your entity owes me an amount of 3 crores as receivables because you owe me an amount of 3 crores. I tell you not to give it to me as the company. Matlab, I tell you, sir, you don't pay it to me as a trade receivable relationship. You pay it to me off the company. You might be thinking, how can they transact off the company and still the amount goes to the CFO of company A? So here is what they agree. So let us say if the amount had been settled, here's how the entry flow would have looked. So it would have been bank account debit 3 crores to entity B account 3 crores. And here they would have passed the entry entity A account debit 3 crores to bank account 3 crores. So this is what would have happened if the amount had actually been settled by entity B to entity A. But the CFO of entity A tells entity B to not do this. So here is what the CFO plans. CFO tells you give this amount as an advance to one of my relatives. So one of my relatives is having a sole proprietorship business. You give this amount as an advance to him. Here is so if the amount is given as an advance, here is how the entry flow would look like. So yeah, advance to Mr. C, like let's say Mr. C is the relative of CFO of entity A to bank. So these two entries would not even have been passed in the respective books. One second, I'm just striking these off because these wouldn't have even happened. This is just a scenario I told which would ideally happen. So yeah, so this is what would have happened. And entity A, what entry will they pass? No entry. So why will entity A not pass an entry, guys? Because this is an advance which is given by entity B to Mr. C, who is a sole proprietor who is doing his business. So why? How is entity A even coming into play here? I hope you understood this. So CFO of entity A is telling CFO of entity B to account the payment as a payment to the CFO of entity A's relative. So now what will the CFO of entity A do? The CFO of entity A will get this amount from his relative. This is what will happen. And Obviously the CFO of entity A is not going to tell the finance team. He will tell the finance team or the receivables team that entity B has not yet paid the amount, so provide for the entire 3 crores in our books. So create a provision towards this, saying that it's not recoverable. Okay, so now we come towards the year end, 31st March 2025. Let's say the auditors come for audit somewhere around April 30, maybe after the books are closed and everything is properly done. The auditors come to audit this. Let's say firm ABC is the auditor of entity A and firm XYZ is the auditor of entity B. Perfect. So when firm ABC is doing the audit of entity A, they will see that, okay, there is an accounts receivable to the extent of 3 crores and it's been due for almost 12 months, because I told you the credit period is just 30 days. It's been due for almost 12 months. It's not yet been received, but the management has fully provided the amount. But still, the auditor of entity A, that is firm ABC, would still want to assess whether it has to be actually written off. So that is where firm ABC will have to actually do audit procedures. But let's say, as I was telling you at the start, let's say entity A is a very big concern. So let's say they compute materiality for the purposes of their audit. So there are three materialities. One is your overall materiality, one is your performance materiality, one is your triviality materiality or your de minimis sum. So I will definitely explain these in a separate video, but I'm sure that all of you would be having a basic understanding of this, considering that you have passed CA Inter, you have studied SA 320, you have studied SA 450. I presume you have an understanding of this. In case you don't, do let me know, do comment down below and I will definitely make a video on this. So let's say the triviality materiality or de minimis sum itself, which the firm ABC computes for entity A, comes out to around 5 crores. So what will the auditors of entity A, that is what will firm ABC document in their work paper for this? They will say that there was a 3 crores receivable for entity A from entity B, but since the amount is not recoverable due to certain trade reasons or due to whatever reason, due to trade reasons, entity A is provided for the amount completely in the books of accounts. Since the amount is below a triviality materiality itself, the amount is below the triviality materiality itself. So triviality materiality is the one that's going to be least in value. So it's so less in value even against the triviality materiality. So so firm ABC will document in their work paper saying that they are not performing any audit procedures on this. Now, let's say firm XYZ, who are the auditors of entity B. Entity B is a very small entity. Let's say firm XYZ also computes the materiality. Let us say the overall materiality itself, which firm XYZ computes, comes to 1.5 crores, right? So in this scenario, what would happen is, let's say this advance is there lying as an advance still in the books. So the advance is not adjusted or knocked off. So let us say actually Mr. C had rendered some services to the entity. Let's say Mr. C actually rendered 4 crores worth of services to entity B. What would be the entry flow here, guys? So the entry flow would basically be as follows. Let's say expenses account debit 4 crores. Just a moment. Yeah. To advance to Mr. C. So the advance will get knocked off because you will first adjust the 3 crores against the advance which you have already given. Then to trade payables 1 crore, or to payable to Mr. C 1 crore. Right. So ideally, the auditor of entity B, that is firm XYZ, should question the management of entity B as to why the advance is still outstanding in the books of accounts, why a corresponding service against the same has not been received. Because this amount of 3 crores is actually more than the overall materiality itself, overall materiality. So the impact of this, if this amount is going to get misstated, is pervasive to the financial statements. So let's say firm XYZ did not even question this. They did not perform any procedures. They did not perform any procedures on advance to suppliers. Let us say both these entities are listed. Let's say entity A is also listed on a stock exchange, entity B is also listed on a stock exchange. Let's say NFRA picks the files of both these entities, audit documentation files of both these entities, maybe 2 years down the line or 3 years down the line. NFRA looks into the audit file of firm ABC. So firm ABC have clearly documented that the amount is below the threshold for testing, and they've also ensured the amount is fully provided for in the books, hence no concerns noted. They've properly substantiated that. While firm XYZ, they have not even performed procedures on an amount which is almost twice their overall materiality. And if this fraud had actually been discovered, it would have had a massive impact. And could this fraud have been discovered? Yes. If firm XYZ had tried to perform some testing on advanced suppliers or even started off with a basic inquiry, this fraud could have been discovered. So NAFRA will definitely slap a penalty on firm XYZ, who are the auditors of entity B. So if you see this case, ideally, if firm XYZ had performed audit procedures and had discovered this fraud, they should have ideally followed the procedure laid down in section 143(12) of the Companies Act, and they should have ideally intimated the board and the audit committee about this. And if they had not responded within the stipulated time limit, they should have ideally sent a letter to the central government on the letterhead and done all of that. But they didn't even have a chance to do that because they didn't even perform any audit procedure on advanced suppliers. So this is a very massive issue. But for firm ABC were not even required to perform procedures on the amount of this 3 crores, because the 3 crores was even smaller than the triviality materiality or the de minimis sum in itself. So I hope you understood that firm ABC has actually substantiated well, they have documented really well, and the amount is not even close to the triviality materiality. It's actually smaller than the triviality materiality. While firm XYZ, the amount is actually exceeding their overall materiality. They should have done audit procedures on it. They should have been able to detect this fraud, and they've not done it. So they will be facing future implications. I hope you understood this, guys, and I hope I was able to justify this to a decent extent. So I hope you found this insightful. So keep learning, keep growing, and do share and do like if you found it useful. Thank you so much, and don't forget to hit that subscribe button. Cheers. Thank you.